Adobe reported earnings last week and the stock tumbled 14%. At the latest share price, the company has a market cap of $232 billion, with $6.8 billion of cash and investments and $3.6 billion of long-term debt. The enterprise value is $228 billion. Revenue over the last 12 months comes to $20 billion, with $4.8 billion of net income and $7 billion of free cash flow. So Adobe's stock is now trading at around 48 times earnings and 33 times free cash flow. Despite falling 14%, this wasn't a bad report from Adobe. Revenue increased 12% and adjusted operating income grew 16%. Gross margins increased to 88.6%, among the very best in the world. And Adobe announced a plan to buy back $25 billion worth of stock. That figure is enough to buy back almost 10% of the company at current prices. So why did the stock fall? The obvious answer is that Adobe's second quarter outlook came in below expectations. The company thinks revenue will grow 9.5% year over year, with adjusted earnings growth of 12%, and 1% of that should come from stock repurchases. Analysts on the company conference call noted a slowdown in Adobe's digital media business. This is an important factor because it's this segment that is most at risk from new artificial intelligence products, like OpenAI's Sora, Midjourney, and countless others. So the key question is whether new AI tools will take market share from Adobe, or whether Adobe's own AI products will allow the business to continue to dominate. The truth is that it's very difficult to say right now. Q1 revenue was still another record for Adobe, and the outlook miss is tiny in the grand scheme of things. Moreover, Adobe often provides conservative guidance because it makes it easier to beat expectations later on. Let's assume that Adobe manages to grow its revenue at 10% per year for the next 5 years, while maintaining a net income margin of 25%. In that scenario, the company would be producing $8 billion of net income in 5 years' time. Assume buybacks in the region of 3% per year and a PE multiple of 40, and Adobe stock would be worth $320 billion in 5 years' time, which works out to an investment return of 10% per year. So even without disruption from artificial intelligence, the return on Adobe stock doesn't look that compelling. I don't think there's enough margin of safety here, which is why I give the stock a negative rating. But these are my personal opinions, not financial advice, and I hold no position in Adobe. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.